Hi, thank you for listening to Reverse Investment Channel. I'm Chi Yao. No matter how high the stock market is, there always will be people shouting the stock market is still cheap. The financial media are behaving like horse racing commentators. Things you should know before market open. Things you should know after market close. Stocks you should buy while they are cheap. Stock you should always own. Stock to invest due to economic data, Fed speech, or even President speech. Are they the real deals? Maybe, maybe not. You should better ask yourself, will the real deals tell you this, or listen to this? Of course the market may go higher. However, is it worth the risk? Cash is powering up. In terms of investing, Warren Buffett is a legendary investor. He knows what he is doing, and he understands valuation extremely well. For an investor like him to not to invest, the only rationale is that the market is overpriced. His company, Berkshire Hathaway, with 72 billion cash on hand, still takes advantages of low interest rate to raise capital. The company itself doesn't need that much cash, but Warren Buffett understands the opportunity cost forward, that a costless chance to invest in companies in the future. For an investor like him, he will not waste any chance to exploit from the market he can grasp. And not just him, all the legendary investors are either holding more cash or hedging downside risk. That accumulation complicates the evaluation. Companies along with consumers have stretched so thin that even a large increase in usage of credit instruments hasn't brought in any revenue boom. In fact, even with the increase in price level, the revenue has been trending lower for 5 quarters. The first reason behind the debt failing to fuel revenue is because most of those new credits that are borrowed go right back into speculation, shares buyback, and leverage buyout. Capital reinvestment used to be 30 to 40 cents on the dollar capital acquired. Now sits just 10 cents on the dollar, which is just enough to cover the capital replacement. The second reason is because the revenue has been already based on debts. People borrow to consume, and companies borrow to survive. But in the end, all debts must be paid back. When credit tightens, all those credit-filled revenue will vanish. Those companies that have stretched too thin won't survive. So why invest under complicated valuation for the unknown risk? The only way out is hyperinflation, but what good does that do to the people? It's the same as massive defaults, as much of the purchasing power vanishes from people. To wrap it up, all legends first put themselves beyond possibility of defeat and then seek for the opportunity of victory. Develop the valuation skill with discipline is the system an investor must have. Embrace the free market and smart money. Thank you for listening to Reverse Investment Channel. This is Chi Yao, signing out for now.